keeping up with the energy world, it can feel, well, overwhelming sometimes, right?
Definitely. So many moving parts.
Exactly.
Yeah.
So today we're focusing on a really big player, Chevron. Their whole aim, as
Yeah.
they put it, is affordable, reliable, and ever cleaner energy. Big promises.
Huge. And that's why in this deep dive, our mission is really to get under the hood. We're going through Chevron's 2024 annual report.
Right.
We want to pull out the key business stuff, the financial picture, and crucially, how they're planning to create value for you, the shareholder. Think of it as, well, your shortcut through all the jargon.
Yeah, your guided tour. We've waded through their official 2024 Form 10K, so you don't have to. Okay, let's get started. Where do we begin with Chevron's business? What are the main parts?
Well, first off, their history in the Gulf of America is pretty remarkable, over 85 years.
Wow.
Yeah, and they're a major producer there. Importantly, they stress their assets have a lower carbon intensity. We're talking about big, deep water platforms like Anchor, Bigfoot, Tahiti.
Familiar names.
And Tahiti alone, get this, has pumped out over 500 million barrels of oil equivalent since 2009.
500 million, that's staggering.
It really is. And speaking of the Gulf, they had a big milestone in 2024, first oil from the Anchor project.
Ah, yes. Anchor, that's the new one, right?
That's the one. And here's where it gets really interesting technologically. It's their first time deploying this deep water, high pressure technology. We're talking pressures up to 20,000 psi.
20,000.
Yeah, and reservoir depths around 34,000 feet. I mean, it's incredibly deep.
Okay, so pushing the boundaries there, what does that mean for production?
Well, they project their total net production in the Gulf could hit 300,000 barrels of oil equivalent per day by 2026. So still a major growth area for them.
Interesting. Okay, what about outside the U.S. international operations?
Big focus there is the Tengiz field in Kazakhstan TCO. In 2024, that produced over 730,000 net barrels of oil equivalent per day. Huge contributor.
Right, and there was a big project finishing up there.
Exactly. The Future Growth Project, or FGP, and the Wellhead Pressure Management Project, WPMP, they completed that.
So what's the impact?
Well, FGP actually started producing in January 2025, just after this report period, but the potential is an increase of around 260,000 barrels per day.
Wow.
The goal is for TCO to hit about 1 million barrels of oil equivalent per day in total output. That's a massive operation.
Okay, so adding it all up, record production overall then.
Yes, for their upstream business, that's the finding and producing part record year in 2024. Over 3.3 million net barrels of oil equivalent per day.
And that's up from 2023.
Up 7%. A really solid increase, and a huge driver, honestly, is the Permian Basin back in the U.S.
The Permian, always central to the story.
Absolutely. Hit a record 921,000 net barrels of oil equivalent per day in 2024. That's nearly an 18% jump from 2023.
18%, that's huge growth.
It is, and it accounts for more than half their total U.S. production now. They actually expect to hit 1 million barrels a day there in 2025.
So the Permian is really firing on all cylinders for them.
It certainly seems that way. It's clearly central to their growth plans, but they're not just focusing on existing areas.
Expanding exploration, too.
Yeah, in 2024, they picked up new exploration acreage in Australia, Angola, Brazil, Namibia, Uruguay, kind of spreading their bets globally.
Diversifying potential future sources.
Yeah.
Makes sense.
Right. And then shifting gears a bit, there's the focus on lower carbon intensity fuels.
Okay, what are they doing there?
Well, they have an oilseed processing plant in Louisiana. It's a joint venture. Bunge Chevron Ag Renewable.
Right, for biofuels feedstuff.
Exactly. And they're expanding their biorefinery in Geismar, also Louisiana. That's expected to start up in 2025 and should really boost their renewable diesel capacity quite a bit.
Tripling it, I think, from 7,000 to 22,000 barrels a day.
Something like that, yeah. A big jump. They're also working on carbon storage test wells at Bayou Bend, expanding storage rights offshore Western Australia.
So building out that side of the business, too.
Slowly but surely. It's still smaller scale compared to oil and gas, but it shows strategic movement.
And what about emissions from their current operations? Methane, for example.
They highlight their efforts there, too, using advanced detection tech. And they report cutting their upstream methane intensity by over 60% between 2016 and 2024.
Which is pretty significant.
It is. Methane's a big focus area environmentally and regulatorily.
Okay. Anything else on the operational or strategic side before we hit financials? Cost cutting.
Ah, yes. They've flagged planned structural cost cuts aiming for $2 to $3 billion by the end of 2026. We actually saw some related severance costs booked in late 2024.
Streamlining things.
Yeah.
And of course, the big one, the Hess merger.
Right. Still pending final approvals, but it got Hess stockholder okay and cleared the FTC antitrust review. So it's moving forward.
And a headquarters move.
Yes, relocating the corporate HQ to Houston, Texas in 2025.
Okay, lots happening operationally. Let's dive into the numbers. How did the finances stack up in 2024? Top line first.
Sure. So sales and other operating revenues came in at $193.4 billion for 2024.
Which sounds like a lot, but how does it compare?
It's actually down. It was $196.9 billion in 2023 and quite a bit higher, $235.7 billion in 2022.
So revenues decreased. Why was that?
The main reason they cite is lower commodity prices. Oil and gas prices weren't as high as the previous couple of years.
Right.
But on the flip side, they did sell more product, higher volumes, so that helped offset some of the price impacts, but not all of it.
Okay, so lower prices hitting the top line. What about the bottom line? Net income.
Net income for 2024 was $17.7 billion.
Also down then.
Also down, compared to $21.4 billion in 2023 and a really strong $35.6 billion in 2022.
Okay, what drove that decrease in profit?
It's a few things. Lower margins in their downstream business, that's refining and selling fuels.
Okay.
Lower prices realized for their upstream production, like we mentioned, affecting revenue. And higher operating expenses, partly due to those severance costs we talked about.
Any positives offsetting those?
Yeah, a couple of things helped. They didn't have certain big decommissioning charges that hit results in prior years. The higher sales volumes helped earnings too, even if revenue was down overall. And favorable foreign currency movements gave them a bit of a boost.
Got it. So a mix of factors. How did the different parts of the business perform profit-wise, upstream versus downstream?
Upstream was definitely the powerhouse. It earned $18.6 billion in 2024. That record production was key there, both in the U.S. and internationally.
Yeah. And downstream.
Much lower, $1.7 billion in earnings for the year. So you can really see the difference there.
Yeah, clear split. What about their stakes in other companies, their affiliates?
Right. Income from equity affiliates, that was $4.6 billion in 2024. Also down a bit from prior years.
Why was that?
Mainly lower earnings from GS Caltex in Korea and also TCO in Kazakhstan, despite its huge production. Earnings were down a bit year over year.
Okay.
But offsetting that somewhat, no major impairment charges like in some previous years, and their chemical joint ventures, CPChem, actually did better.
And TCO's contribution specifically?
Yeah.
Still significant.
Oh, yeah. Chevron's share of TCO's net income was $5.8 billion in 2024. Still a huge number, even if it was down from $6.6 billion in 2023 and $8.6 billion in 2022.
Got it. There was also a line item, other income, that seemed quite high.
Yes, that jumped to $4.8 billion. Main reasons there were, again, the absence of those prior decommissioning charges, some gains from selling assets in Canada, favorable foreign exchange effects, and higher dividend income they received.
Okay, let's circle back to production numbers quickly. That record, 3.3 million barrels a day. How did that break down geographically?
Sure. About 1.6 million barrels per day came from the U.S.
Right.
And about 1.7 million barrels per day from international operations. So a pretty even split.
And within the U.S., the Permian and Gulf were the big ones.
Absolutely. Permian and 921,000 barrels a day, and significant contributions from the Gulf of America, too.
Okay. Now, reserves. Always critical for an energy company. How did those look at year-end?
Their proved reserves were 9.8 billion barrels of oil equivalent at the end of 2024.
Which was down from 2023.
Yes, it was a decrease from year-end 2023, and their reserve replacement ratio for the single year 2024 was actually negative 4%.
Negative 4%. That sounds not great.
Well, it's not ideal for a single year, but you have to look at the longer trend, too. That ratio can bounce around quite a bit based on project timing, revisions, prices. Their 5-year and 10-year average reserve replacement ratios are considerably higher, well above 100% usually. So 1 year doesn't tell the whole story.
Okay, important context. What about investment back into the business? Capital spending, CapEx?
CapEx in 2024 was $16.4 billion. That's up about 4% from the $15.8 billion they spent in 2023.
Mostly on upstream.
Primarily, yes. More investment in those production projects. Looking ahead to 2025, they're guiding for CapEx between $14.5 and $15.5 billion.
So slightly lower, maybe?
Potentially, yeah. Still mostly upstream. They've specifically earmarked $4.5 to $5 billion just for the Permian within that.
Wow. Still a huge focus.
Definitely. And about $1.5 billion is allocated for those lower carbon intensity and new energy ventures we talked about.
Okay. And spending within affiliates like TCO.
Their share of affiliate capex was $2.4 billion in 2024. They expect that to be lower in 2025, somewhere between $1.7 and $2.0 billion, with less than half of that being for TCO now that the big project is wrapping up.
Got it. Let's talk cash flow. Free cash flow is always a number people watch closely.
Right.
But
So cash from operations minus capital expenditures. For 2024, Chevron's free cash flow was $28.2 billion.
$28 billion. That's a lot of cash.
It is. It gives them a lot of flexibility.
Which brings us nicely to shareholder returns, right? What do they do with that cash?
Absolutely. Returning cash to stockholders is clearly a major priority. In 2024, they returned a record $27.0 billion.
Record $27 billion.
Through dividends and share buybacks, they spent $15.2 billion just on repurchasing their own shares.
$15 billion in buybacks alone.
Yeah, and they point out it's the 17th time in the last 21 years they've done buybacks. Plus, they emphasize dividend growth, a 6.2% compound annual growth rate from 2009 to 2024. So, a pretty consistent story of returning cash.
Okay, that is a substantial return. So, wrapping things up, looking forward, how does Chevron position itself based on this report?
Well, they start by noting that global energy demand hit a record in 2024, and they expect another record in 2025. They stress that oil and natural gas remain essential.
Meeting current demand.
Exactly. They also mention the huge global investment happening in energy, over $3 trillion in 2024, with more than a third still going to traditional sources, and they see that level of investment continuing through the decade.
So the context is high demand and high investment, and their objective within that.
They state it as safely deliver higher returns, lower carbon, and superior shareholder value in any business environment.
The all of the above strategy almost.
Sort of, yeah. They also mention their 2050 net zero upstream aspiration again. That's for their scope 1 and 2 emissions on an equity basis.
Right. Direct operational emissions and emissions from purchased energy, accounting for their share in joint ventures.
Correct. But they're very clear achieving that depends heavily on new technology, supportive policies from governments, and critically, making carbon capture and storage work at scale.
So aspirational, but with caveats. Are they putting money behind the lower carbon part?
Yes. They've outlined plans to spend about $10 billion in capital on lower carbon projects through 2028.
$10 billion through 2028. How does that break down?
Roughly $2 billion is aimed at reducing the carbon intensity of their current operations. The other $8 billion is for things like renewable fuels, hydrogen, carbon capture, and offsets. And they note they've already spent $7.7 billion towards lower carbon since 2021, including the REG acquisition.
Okay, so significant spending plan there. It really sounds like a balancing act.
It absolutely is. They acknowledge the huge uncertainties in the energy transition. Their strategy seems to be about keeping flexibility in their portfolio while targeting those harder-to-abate sectors with some of these newer energy solutions.
Okay, so if we had to summarize the key takeaways from this deep dive into Chevron's 2024.
I'd say strong operations, especially upstream production led by the Permian, strategic investments continuing in both their core oil and gas and growing lower carbon initiatives, and a really significant focus on returning cash to shareholders.
Yeah, record returns in 2024. They seem to be navigating this complex energy landscape by trying to perform well in the present while building options for the future.
That sums it up pretty well. They're trying to meet today's energy needs while acknowledging and starting to invest in tomorrow's, even with all the unknowns involved.
Okay, so here's something to chew on as we finish. We see this record global energy demand right now, but we also see this undeniable push towards a lower carbon future. How does a company like Chevron really square that circle? How do they manage that fundamental tension between meeting today's massive needs and hitting those long-term green goals? And maybe more importantly, what are the specific tech breakthroughs that will actually make or break that balancing act?
That's the trillion-dollar question, isn't it?
It really is. Something for you to think about.